At 6:47 this morning, Eastern Time, inside JPMorgan Chase's Executive Command Center on the 47th floor of 383 Madison Avenue in Manhattan, a classified internal memorandum began circulate among the bank's top 12 senior strategists that contains language financial analysts are calling the most alarming institutional warning issued by any major American bank since the 2008 collapse. The memo, portions of which have been leaked to multiple news outlets over the past 90 minutes, predicts a catastrophic devaluation of the United States dollar beginning as early as the third quarter of this year, with JP Morgan's chief strategist writing in language described by three people who have read the document as apocalyptic in tone and unprecedented in its certainty, that the bank's modeling now shows a 73% probability of what the memo terms total loss of dollar reserve currency status by September 2026. I need you to understand the weight of what I am about to tell you, because what leaked from JP Morgan's executive suite this morning is not merely a market prediction or quarterly forecast adjustment. This is the largest financial institution in the United States, an entity managing $9 trillion in assets, telling its most senior decision-makers to prepare for the complete restructuring of the global monetary system within the next 6 months. And if you care about your retirement savings, your purchasing power, or whether this country maintains any semblance of economic sovereignty over the next 18 months, you need to subscribe to this channel right now and turn on notifications, because the financial developments happening at this very moment will determine whether the American middle class survives what multiple economists are now privately calling the greatest wealth transfer event in modern history. Here's what we know from three separate sources: two who work directly in JP Morgan's Global Markets division, and one who serves as senior advisor to the bank's Asset and Wealth Management Unit. The internal memorandum, designated as Code Red classification within JP Morgan's document hierarchy, which means restricted circulation to only C-suite executives and division heads, was distributed at 6:31 a.m. this morning, following an emergency overnight meeting that began at 11 o'clock p.m. last night and ran until 4:47 a.m. this morning. According to two people briefed on the meeting, the gathering included 12 participants: JP Morgan's Chief Executive Officer, the Chief Financial Officer, 3 managing directors from Global Markets, 2 senior strategists from Asset Management, the head of currency trading, the director of sovereign risk analysis, and 3 external consultants whose identities remain protected, but whose sources describe as former Federal Reserve officials and international monetary policy specialists. The meeting was not listed on any official calendar, took place in a secure conference room typically reserved for litigation strategy and regulatory crisis management, and according to security logs reviewed by one source, required biometric clearance and surrender of all electronic devices before entry. The fact that JP Morgan convened this level of senior leadership, in complete secrecy, in the middle of the night, using security protocols typically reserved for Department of Justice investigations, tells you everything you need to know about how seriously the bank's executive leadership is taking the projections contained in this morning's leaked memorandum. The memorandum itself runs 47 pages according to multiple sources who have described its contents, though the leaked portions that have reached news outlets represent only fragments totaling approximately 6 pages of summary conclusions and strategic recommendations. What makes this document so significant is not merely its conclusions but its methodology. JP Morgan's quantitative analysis division, widely considered among the most sophisticated predictive modeling operations in global finance, employed what sources describe as an entirely new analytical framework developed over the past 8 months, specifically to model catastrophic currency scenarios that previous economic models classified as statistically impossible or outside reasonable probability ranges. One source familiar with the modeling process explained that JP Morgan's team essentially built what they internally call a black swan probability engine, designed specifically to identify low probability but high impact events that conventional economic forecasting systematically fails to anticipate, because those models assume system stability and rational actor behavior. The decision to build such a model in the first place reveals that someone high in JP Morgan's analytical chain of command believed conventional forecasting was missing existential threats, and the fact that this new model is now showing a 73% probability of dollar collapse by third quarter suggests those fears were not merely theoretical anxiety, but based on pattern, recognition of actual developing conditions that traditional models are programmed to discount or ignore. According to the leaked summary sections, JP Morgan's analysis identifies 7 converging factors that their modeling shows are creating what the memo terms a terminal cascade effect on dollar stability. First, accelerating de-dollarization among BRICS nations, with specific reference to petroleum transactions increasingly settling in yuan, rupees, and rubles rather than dollars, creating what the memo describes as a 47% reduction in petrodollar recycling over the past 18 months. Second, unprecedented federal deficit spending, with the memo citing Congressional Budget Office projections showing the national debt reaching $49 trillion by 2029 and debt service costs consuming 23% of all federal revenue by 2027. Third, what the memo terms the weaponization collapse, referring to international perception that EU deployment of dollar-based sanctions against Russia, China, and other nations has transformed the dollar from neutral reserve currency into coercive foreign policy instrument, accelerating the search for alternatives among both adversarial and allied nations. Fourth, structural inflation embedded in domestic supply chains and labor markets that JP Morgan's modeling shows cannot be controlled through interest rate manipulation without triggering recession deep enough to cause social instability. Fifth, the exponential growth of Bitcoin and stablecoin adoption, with specific citations of payment networks now processing more international transactions in crypto than through traditional dollar-denominated banking systems. Sixth, and this is the factor multiple sources say shocked even the most senior executives in last night's meeting, credible intelligence suggesting that Saudi Arabia is within 60 days of announcing it will accept Chinese yuan for oil transactions, which the memo describes as the single most significant threat to dollar reserve status since the Bretton Woods Agreement of 1944. And seventh, what the memo calls central bank capitulation, with specific reference to the fact that global central bank dollar reserves have declined for 9 consecutive quarters, the longest sustained reduction in dollar holdings since central bank reserve data began being systematically tracked in 1971. Now here is where this story moves from concerning economic analysis to genuinely alarming institutional behavior. The strategic recommendations section of the memorandum, according to 3 people who have read it, instructs JP Morgan's senior leadership to begin what the document terms defensive repositioning across multiple operational divisions. This language is important because banks like JP Morgan do not use the word defensive in strategy documents unless they are preparing for scenarios where offensive or growth-oriented positioning would expose the institution to catastrophic loss. The specific recommendations include reducing dollar-denominated sovereign debt holdings by 35% before the end of June, which would represent the largest sovereign bond sell-off in JP Morgan's history. The memo recommends increasing commodity positions, particularly gold, silver, and strategic industrial metals, with target allocations that would represent a 412% increase in physical commodity holdings compared to current positions. It recommends establishing what the document calls crisis liquidity facilities in Swiss francs, Singapore dollars, and Norwegian kroner, currencies the memo identifies as most likely to maintain stability in a dollar devaluation scenario. Perhaps most telling, the recommendations include preparation of client communication protocols for what the memo terms managed panic prevention, with specific instructions to develop messaging strategies that prepare wealth management clients for major portfolio restructuring without triggering mass redemption requests that could compromise the bank's liquidity position. When a bank the size of JP Morgan is writing internal memos about managed panic prevention, you are no longer talking about theoretical risk modeling. You are talking about an institution actively preparing for a scenario it believes has better than even odds of occurring within the next 6 months. If this sounds like the kind of information that should be headline news on every major network and front-page coverage in every serious newspaper, you would be correct, and the fact that it is not receiving that coverage tells you something deeply concerning about the current state of American financial journalism. Take a moment right now and hit the like button on this video, because the algorithm tends to suppress financial content that questions dollar stability or suggests systemic economic problems, and the only way this information reaches the people who desperately need to understand what is developing is if you actively signal to YouTube that this content deserves distribution. The establishment media has spent the past 4 hours, since portions of this memo began leaking, treating this story as inside baseball for financial professionals rather than information that directly affects every American who holds dollar-denominated assets, receives income in dollars, or plans to retire in a dollar-based economy. That editorial decision is not accidental. There are powerful institutional and political interests heavily invested in maintaining public confidence in dollar stability, regardless of what private modeling by the most sophisticated financial institutions is actually showing, and your engagement with this video directly counteracts the algorithmic and editorial suppression that prevents this information from reaching mass awareness. Let's understand how we arrived at this moment by examining the timeline that led JPMorgan to develop catastrophic currency modeling in the first place. In March 2022, following Russia's invasion of Ukraine and the subsequent decision by the United States and European allies to freeze Russian central bank reserves denominated in dollars and euros, something shifted in global financial architecture that many Western economists and policymakers either failed to recognize or chose to publicly dismiss. For the first time in the post-World War II monetary order, a major economy watched the United States government unilaterally freeze sovereign assets that international law and decades of precedent had treated as inviolable. Russia's central bank held approximately $300 billion in foreign exchange reserves, roughly half of which were held in dollars and euros in Western financial institutions. The Biden administration, in coordination with European allies, simply froze those assets, rendering them inaccessible to the Russian government. From a Western foreign policy perspective, this represented a powerful new sanctions tool that could inflict economic damage without military engagement. From the perspective of every other nation holding dollar reserves in the global financial system, it represented something fundamentally different, proof that dollar holdings are not actually assets, but contingent permissions that can be revoked at any moment, based on political decisions made in Washington. The consequences of that perception shift took time to materialize, but they were both predictable and profound. In April 2022, Saudi Arabia began preliminary discussions with China about settling some oil sales in yuan rather than dollars. In June 2022, India announced it would purchase Russian oil using rupee-ruble transactions, explicitly bypassing dollar settlement systems. By August 2022, Brazil and China had established direct currency swap arrangements, allowing bilateral trade to settle in reais and yuan without dollar intermediation. These were not random developments by nations with no connection to each other. These were coordinated responses by countries watching what happened to Russia and drawing the obvious conclusion: dollar reserves held in Western financial institutions are not safe from political seizure, and therefore diversification away from dollar dependence is not merely prudent, but existentially necessary for any nation that might someday find itself in political conflict with Washington. Throughout 2022 and 2023, the Federal Reserve and Treasury Department publicly dismissed these developments as marginal adjustments that posed no serious threat to dollar dominance. Jerome Powell testified before Congress in March 2023 that dollar reserve status was secure and that the international monetary system showed no signs of significant structural change. Janet Yellen gave multiple speeches through 2023, arguing that there was no credible alternative to the dollar for international reserve currency status. The mainstream economic consensus held that even if some nations were exploring alternatives, the depth, liquidity, and institutional stability of dollar-based financial markets made any meaningful de-dollarization impossible within any relevant time horizon. That consensus was not based on ignorance or deception. It was based on models that assumed system stability and rational actor behavior within existing institutional frameworks. What those models failed to anticipate was the possibility that rational actors might collectively decide the existing institutional framework itself had become unreliable, and that even if no perfect alternative to the dollar existed, a diversified portfolio of imperfect alternatives might be preferable to concentrated dependence on an asset that could be frozen based on political decisions. Now we are in early 2026, and the data is becoming impossible to ignore, even for the most committed defenders of dollar dominance. Global central bank dollar reserves have declined from 61% of total reserves in late 2021 to 52%, as of the most recent Bank for International Settlements data released last month. That represents the fastest sustained decline in dollar reserve holdings since the creation of the euro in 1999. China's central bank has reduced its dollar reserves by an estimated $400 billion since 2022, while simultaneously increasing gold reserves by over 1,000 tons. Saudi Arabia, the linchpin of the petrodollar system for the past 50 years, is now conducting active negotiations with multiple nations to accept alternative currencies for oil sales. The BRICS nations, which collectively represent 42% of global population and 31% of global GDP, are advancing plans for a common settlement currency that would further reduce dependence on dollar transactions. The psychological and institutional momentum behind these shifts is what JPMorgan's new modeling framework is designed to capture. Traditional economic models treat currency adoption as a rational optimization problem where actors choose the most efficient option based on transaction costs, liquidity, and stability. But currency adoption, particularly at the scale of reserve currency status, is not purely an optimization problem. It is a network effects problem combined with a confidence game. The dollar's dominance does not rest primarily on superior fundamentals. It rests on collective belief that everyone else will continue using dollars, which creates a self-reinforcing cycle where dollar dominance is rational, because everyone expects everyone else to continue believing dollar dominance is rational. This type of equilibrium is stable until it is not. Once enough actors begin to question whether others will continue accepting the same assumption, the entire structure can shift with shocking speed. This is what JPMorgan's Black Swan probability engine is apparently designed to model, the conditions under which collective confidence in dollar dominance reaches a tipping point where the rational strategy switches from continuation to diversification. And once that switch occurs across enough major actors, the cascade effect becomes self-reinforcing and essentially unstoppable within the time frame required for policy intervention. What makes the leaked memo so alarming is not just the 73% probability figure, though that alone would be extraordinary. What makes it alarming is that JPMorgan is a conservative institution with enormous vested interest in dollar stability. This is not a Goldbugs newsletter or cryptocurrency evangelist predicting dollar collapse to promote alternative assets. This is the largest bank in the United States, an institution whose entire business model depends on dollar-based financial intermediation, privately telling its senior leadership that their best modeling shows nearly 3 in 4 odds that the dollar loses reserve currency status within 6 months. When an institution with that profile reaches that conclusion, you are looking at something far more serious than speculative doomsaying or political narrative construction. You are looking at hard-nosed financial professionals with access to proprietary data and sophisticated modeling tools concluding that catastrophic currency devaluation has moved from theoretical tail risk to probable central scenario. Before we go further, I want you to head down to the comments section and tell me your answer to this question. Do you believe the federal government and Federal Reserve have the policy tools and political will to prevent dollar devaluation, if JPMorgan's analysis is correct? Or has the situation already progressed beyond the point where traditional monetary and fiscal policy can arrest the cascade? This is not a rhetorical question. I want to know what you think, because the answer to that question determines whether we are looking at a crisis that can be managed through conventional policy response, or whether we are looking at a fundamental restructuring of the American economy that will require entirely different preparation and adaptation strategies. Drop your thoughts in the comments, and let me know where you stand on whether this can be stopped, or whether we are already past the point of no return. The timeline from here becomes critical, and this is where the third quarter deadline mentioned in the leaked memo starts to make more sense when you understand what financial and geopolitical events are scheduled to occur between now and September. In late April, the International Monetary Fund holds its spring meetings in Washington, where finance ministers and central bank governors from 190 member nations gather to discuss global economic coordination. According to 2 sources familiar with the planned agenda, Several major emerging market nations are preparing to formally propose reforms to the IMF's special drawing rights system that would reduce dollar weighting and increase representation of yuan, rupees, and potentially even gold-backed settlement mechanisms. The proposal itself is not expected to pass given U.S. veto power within IMF governance, but the public debate and vote count will provide the first clear indication of how many nations are willing to openly align against dollar dominance, even in a forum where the United States holds structural control. In June, the BRICS nations are scheduled to hold an expanded summit in Johannesburg, South Africa, where over 40 nations have requested either full membership or observer status in what was originally a coalition of just 5 countries. According to diplomatic sources who have reviewed draft agenda documents, the summit will include formal presentations of a proposed BRICS common settlement currency, backed by a basket of commodities and member nation currencies. The technical specifications have been in development for over 2 years, but June represents the first time political leaders will be asked to make formal commitments to adoption timelines and implementation frameworks. If even half of the nations attending that summit agree to begin using BRICS settlement mechanisms for bilateral trade, it would represent the largest coordinated shift away from dollar-based transactions in the history of international finance. But the event that JPMorgan's Memo apparently identifies as the most likely trigger for cascade acceleration is scheduled for early July. Saudi Arabia's current agreement with the United States regarding dollar-exclusive oil pricing, an informal arrangement that has formed the backbone of petrodollar recycling since 1974, is set to expire on July 9th. Unlike formal treaties, this arrangement has operated through a series of rolling understandings and diplomatic commitments that require periodic renewal. According to 3 sources with knowledge of ongoing negotiations between Washington and Riyadh, the Saudis are demanding significant concessions on arms sales, security guarantees, and U.S. positioning on regional conflicts as the price for continuing dollar exclusivity. The Biden administration, constrained by congressional opposition and domestic political considerations in an election year, has so far been unwilling or unable to meet those demands. If Saudi Arabia announces on July 10th that it will begin accepting yuan, rubles, or euros for oil transactions, even if it maintains dollars as the primary settlement currency, that announcement alone could trigger the confidence cascade that JPMorgan's modeling predicts. The psychological impact of Saudi Arabia, the nation most identified with petrodollar arrangements, publicly acknowledging that dollars are no longer the only acceptable currency for oil, would signal to every other nation and institution that dollar dominance is no longer assumed permanent, and that signal could accelerate diversification decisions across the entire global financial system. This is why JPMorgan's third-quarter timeline is not arbitrary or speculative. The memo is identifying a sequence of scheduled events between April and July that create what the document reportedly terms critical decision nodes where collective belief in dollar permanence will be tested in public forums with immediate market consequences. If those decision nodes break in the direction of de-dollarization, which JPMorgan's modeling shows as the more probable outcome, then third quarter becomes the period when the cascade effects start manifesting in currency markets, sovereign bond yields, and international capital flows. This is not a prediction that the dollar will cease to exist or that American currency becomes worthless overnight. This is a prediction that dollar reserve currency status, the privileged position that allows the United States to run persistent trade deficits and issue unlimited debt at artificially low interest rates, will be permanently lost, and that loss will require fundamental restructuring of American fiscal policy, monetary policy, and the social programs and military commitments those policies currently support. Let's talk about what dollar collapse actually means in practical terms for regular Americans, because I think there is significant confusion about what we are discussing when we use terms like collapse or catastrophic devaluation. We are not talking about the dollar going to zero or American currency becoming worthless paper. We are talking about a repricing of dollar purchasing power relative to other currencies and real assets, combined with loss of the structural advantages that reserve currency status provides. Here is what that looks like in concrete terms. Currently, the United States can import goods worth $800 billion more than it exports every single year, because other nations are willing to accumulate dollars and dollar-denominated assets in their reserves. This is called running a persistent trade deficit, and it allows Americans to consume far more than the nation produces because foreign nations are willing to accept dollars in exchange for real goods based on the assumption that those dollars will retain value and utility. If dollar reserve status is lost, that assumption breaks, and foreign nations will demand either higher prices for their goods to compensate for currency risk or will simply refuse to accept dollars at all, demanding payment in currencies or commodities they trust more. For the average American, this manifests as import price inflation,